Hey, welcome to another great show set up for Thursday afternoon on Mortgage Minute. I'm Jeff Harrison, and I'm going to be joined by Art Alvarez. He is the king of mortgages at MortgageWorks. He's been doing what he's been doing for over 42 years. He has seen the ups, downs, the craziness in the market, and he's going to help put some sanity back into what's going on. I've read things this week about, hey, what's going on with the Fed? Have they broken the market when it comes to housing? I don't know. I don't think so. I think, I've spoken to Art on many occasions, and he's talking about, when the rates were like 17%. And I said, well, back then, did people buy houses? He said, sure, they did. They just bought houses. So I suspect the same thing will happen here. And as the economy continues to steam along, if you will, we're going to keep making things happen and sell houses and help you get loans. So with that, let's bring in Art Alvarez of MortgageWorks. Hey, Art,
Hi,
welcome
Jeff.
to the show.
Yeah.
Good. How about yourself?
Not bad, not bad. I'm thinking, since you mentioned me being the king of mortgages, does that mean I should be referred to as King Arthur, maybe?
Ooh, I like that. Let's change your name to King Arthur. I like it. I like it. I think the guy who owned that's out of, so there's not like a copyright infringement, or we're not going to get anybody upset. If I start calling myself Madonna, she might come after, well, maybe, I don't know. Somebody would come after me.
Yeah, the statute of limitations for King Arthur, I think, is expired. So,
yeah. Does that mean we should start working from a round table?
There you go. I like that idea.
I like that. Well, things are a little strange out there. We're going to talk about some things. I know you're going to share some things with us today that we haven't seen in a long time. Yeah. And at the same time, I'm excited about having a conversation with you over a subject that, when things get expensive or things go up in price, there's always people wondered, well, am I really getting a good deal, or are there things not being exposed? And I can't wait to talk to you more about that. So with that in mind, sure. I want to turn it over to you and just remind people, hey, this is a live show. I'm going to be monitoring the comments both on YouTube and Facebook. If you have a question or a comment, please put them in the comment section, and I'll see that and I'll give that to Art, and he'll get your questions answered, because let's face it, MortgageWorks, you have the answers. They're on the house. With that, I'm going to turn it over to you, Art.
Thank you, Jeff. Thank you, everyone. Thanks for watching this week's edition of Mortgage Minute. As you know, I like to start off by giving you a little bit of a market update, in particular, an update about the bond market and mortgage rates. So let me give you that news. And unfortunately, to some degree, it's not the best. There's our rate grid on our website, where you can see the current interest rate indications, as I call them. As you can see, we're basically definitely in a 7% market. You can still get some FHA VA loans under 7%, but for the most part, it's about a 7% plus market. So why is that? Well, if you look at the 10-year bond yield chart, which Jeff's going to pull up here, unfortunately, you can see some additional gradual rise in the 10-year bond yield since the end of last week, although thankfully today, we have been seeing a little bit of improvement after a kind of a rough week, particularly when you look at this chart from about yesterday morning to now. You see that pretty good jump in the bond yield. So what's going on there? Well, this week, in terms of the economic calendar, not a really packed calendar in terms of economic data, but probably the big one that I think did cause a pretty good spike in the 10-year bond yield was yesterday. The durable goods orders, that index came out stronger than expected, a 0.2% increase in August, when actually a drop was forecasted. Well, why the increase? Well, it turns out most of that increase, it looks to be military spending associated with kind of restocking armament supplies, et cetera, with the Ukraine war going on. So that really kind of spooked the bond market in particular, and I think is the predominant reason we saw the jump in bond yields yesterday. We actually, saw the 10-year bond yield get up over 465 when it was, back closer to 4.5 earlier this week. That's a pretty good jump, and of course, as you saw on the chart previously, at least the yield has dropped back below 4.6, around 4.58. So that's a little bit encouraging. Today, we did have initial jobless claims come out. They were increased, but only slightly. They were expected to be higher, a greater number of claims to be filed, but it was not that much. And then the GDP revision ended up being unchanged, 2.1% for the second quarter. That was forecasted to be slightly higher. So that resulted in a relatively quiet day in the bond market with, again, the yield trending a little bit better as the markets are closing. Tomorrow is a pretty important number, the core PCE, that's personal consumption expenditures. That's the Fed's favorite index to gauge inflation. The core PCE is the money spent on goods and services, excluding food and fuel, which are considered pretty volatile. And so by excluding those two items, the PCE is considered by the Fed to be a better barometer of overall inflation. And the forecast for this is for PCE to drop in August to 3.8%. It was over 4% in July. And then I think the background or the backdrop to all of this in terms of the current markets is the jitterness associated with the budget talks and the potential of a government shutdown, possibly by this weekend. So I think that backdrop is also creating some, jitters in the market. So that's where we're at in terms of the bond market and mortgage rates. Not the greatest of news, but at least we're getting some improvement today. And so we'll see what happens tomorrow with the PCE. Next thing I wanted to talk about, home prices. As you know, I've talked about a lot over the last few months. Home prices have been an interesting data point to observe because there's been some mixed signals about it. Well, I wanted to point out there was an article came out on the 26th on Yahoo Finance. Case-Shiller just issued their latest index numbers. And in July, they indicated there was again, these are national numbers, by the way, a 0.6% increase month over month. And this is a new high for the Case-Shiller index. And it also reflects that home prices have actually climbed for the sixth consecutive month after they had actually decreased a little bit going back to January, beginning of this year. The other thing that came out was the inventory of unsold listings declined quite a bit, 14.6%. So that's not good news. That means less inventory of homes for sale. And of course, less inventory is probably the main culprit that is keeping home prices elevated, at least in most markets. Excuse me. The other important number that came out today was existing home sales, only about 4 million now when they were over 6.5 million in early 2022. And then given all of this, CoreLogic is forecasting that by July of 2024, we're going to see home prices up 3.5% gain year over year by July of 2024. So the overall news here, while some of you may be waiting for home prices to improve, I wouldn't bet on that. And in fact, the data is suggesting the opposite. Home prices have not fallen significantly in most markets. And in fact, at least half of the major markets in the country, they've actually gone up. So I think that's going to continue. So to the extent you're waiting for better rates, maybe it makes more sense. But understand if those better rates occur, if rates do drop, I think that's actually going to push prices even higher. So just keep that in mind as you decide, when's the best time to really get serious about buying a home. So just wanted to give you that update. Home prices continue to set records. They're not jumping up in substantial ways, but they're definitely remaining firm and definitely a bias toward the upside. Now, with that, I want to go into a few questions. We did a question and answer session last week, and I want to do the same again this week. We are having a little bit of internet issues, so in terms of doing that, we'll see how it goes. Over a few questions that we have for this segment. Jeff, welcome back.
Thanks, Art. Hey, thank you, Art. These questions, I think they're absolutely pertinent right now. I just want to ask you a question. With the inventory down over 14%, does that mean people are starting that are buyers are being less choosy when it comes to, hey, at least there's something to buy, or are we seeing more homes that are actually coming onto the market?
Well, keep in mind, we're talking about the inventory of unsold listings. So that inventory of listings dropped in July by 14.6%. So what that's suggesting is that we've got after July, even less inventory for sale than we had before. So the point is the inventory of homes for sale is shrinking. I think that has mostly to do with the fact that There's still too many homeowners with very low rates, and they're choosing not to sell. Those who have listed their homes, some of those are getting sold, but I guess overall what that means is the rate of sales is absorbing enough of that inventory without enough new inventory being added, that overall the available inventory is still shrinking. There's a bias towards shrinking rather than growing. We're still at a supply of about 3 months of inventory when it should be 6 to be a balanced market.
Wow, that's amazing. Well, with that being the case, it's the old supply and demand thing. When the supply is low, demand's high. What happens to prices? They typically go up, and negotiation opportunities change. And I wanted to ask you the situation when it comes to loan broker fees. But before we get into that, let's just kind of set the foundation of, who are the primary providers of mortgage loan financing for prospective home buyers here in the U.S.?
Yeah, that's a good question. I have a little experience with that because I've been involved in 2 different segments of the provider list that I'll explain to you. If you think about it, it's pretty simple. If you're going to get a mortgage in the U.S., the primary providers are going to be obviously banks. I would say the other common one, credit unions, mortgage banks, which I'll explain what that means in a minute, and then mortgage brokers. Now, obviously in that list, and so there's 4 major providers, I would argue, and of that list, 2 of the 4 are what we would refer to as depository institutions. So they have the ability to fund loans out of their deposit base. That doesn't mean that they're going to hold those loans in portfolio. These days, most major banks and even most of the credit unions don't do that. They're going to end up selling those loans on the secondary market, even though they may still service the loans, that is, collect the payments from the borrowers. But the other 2 main providers, mortgage banks and mortgage brokers, they're not depository institutions. They're not lending their own money. Certainly brokers are not. Mortgage banks is sort of a hybrid. What a mortgage bank does, they're not a traditional bank. They are a company that has lines of credit set up with major commercial banks, and those lines of credit are used to fund mortgage loans. And they fund mortgage loans that mortgage bank does internally underwrite and approve. And then, of course, they fund them out of their credit line, which is called a warehouse line of credit. And then after that loan's funded, the loan typically gets sold to the end investor, be it Fannie Mae, Freddie Mac, or possibly another mortgage lender or bank. And then that way they get reimbursed for that money that was dispersed to fund the loan out of their credit line. So they can then get that money back from the sale of the loan and put it back in their credit line so they can fund again. So it's kind of a recycling of the credit line to fund their loan activity. Mortgage brokers, of course, we are very specialized in that we're focused only on the origination piece of the transaction. We're not going to underwrite the loan. We're not going to fund the loan. We're going to deliver that loan to another lender, typically a wholesale lender, which can be a bank or a mortgage bank. And then they're going to go ahead and fund the loan. When I got started in the business in my career, I went to work for a mortgage bank. And I was there for 16, 17 years, actually. And it was interesting because during that time, I was kind of trained to believe that we were more sophisticated and a better source for a borrower than a mortgage broker. Although I've since kind of changed my opinion on that, which I'll touch on soon. So, but that's the major differences in terms of the providers.
Yeah, so that kind of fills it out with 4 major providers. So exactly what does a mortgage broker do, and why should a homeowner or a home buyer, if you will, consider a mortgage broker over the other mortgage loan providers that you mentioned?
Yeah, that's a good question. We get that a fair amount, and again, as I mentioned, when I got into the business, I went to work for a mortgage banking company. And of course, we had a particular culture, and I was sort of raised in the belief that, again, a mortgage broker was somehow a less sophisticated provider, not as skilled, not as educated, not as trained, et cetera. And in reality, I have come to learn after my first, many years with a mortgage banking company and then becoming a mortgage broker, there's really some untruths to that. I would argue, in fact, a mortgage broker is probably, of the different providers I described, I would say by and large, most of us in the mortgage broker arena tend to be more experienced, probably more, go through more training and licensing, and are basically better skilled in terms of underwriting and knowing all the programs. And that's the point, is because what we do as a broker, we're pretty specialized because we're an intermediary between the borrower and whoever that lender is who's going to fund the loan. And as a consequence, we will tend to be a little bit more hands-on with the borrower. Our focus is very consumer direct oriented. A lot of the banks and credit unions and mortgage banks sometimes will tend to get their business through wholesale channels like us. But we're going to be a little bit more direct with the consumer. Our job basically is to, first of all, listen, understand the borrower's needs and wants, what they're trying to accomplish. Then what we do is, either based on our experience, we'll know what best program or lender is going to be used or should be used to serve their situation. And if we don't readily know what's the best option for them, then we're going to do the research among a multitude of lenders to find them the best option for their particular situation. So we're going to try to tailor-made a mortgage program solution to their situation. With a lot of the major banks, credit unions, they've got a particular menu of loan products. And if your situation fits one of those, great, they can serve you. But in a lot of cases, the home buyer, the borrower, may have a need for a product that's not with a particular bank or a particular credit union or even a mortgage bank. As a mortgage broker, I can provide more options. I can provide a Fannie Mae, a Freddie Mac, a FHA, a VA, a jumbo, a reverse mortgage, a USDA, as well as all the non-QM products that are out there for people who don't fit the conforming guidelines. A lot of the major banks, credit unions, et cetera, they don't have that wide array of product options that we do. And more importantly, we're probably the best in terms of being a low-cost provider of the mortgage origination process, because we don't have a bunch of branches with fixed overhead and all that. So our overhead's very low. The costs we incur in terms of taking that borrower and packaging a loan file and getting it delivered to the lender, our cost basis is pretty low compared to those other providers. And in fact, one of the interesting things about being a broker is, over the years, it's always been perceived that brokers will tend to charge more to the borrower, both in terms of the rate, in terms of fees like points or origination fees, as well as what used to often be called junk fees. But in reality, there seems to be some data that suggests otherwise. UWM, a major wholesale lender in the country, in fact, they argue they're the biggest ones in the country. They did a big promotion in 2021, for example, pointing out that according to HMDA data, now HMDA is the Home Mortgage Disclosure Act administered by HUD, where they collect data from lenders as to the loans they've funded to monitor all the characteristics, not just for possible discrimination problems, but also what each borrower ultimately paid for getting that mortgage. And the data, believe it or not, shows that on average, at least true in 2021, a mortgage borrower would save on average about $9,400 by using a broker rather than a major bank or credit union or mortgage bank. So that's sort of counterintuitive to what the story has been in the consumer marketplace, that watch out, brokers are going to charge you more, they're going to rip you off, and they're going to hit you with all these junk fees. Well, in reality, in many cases, that's just not the case. Part of the reason for that is because as a broker, I have access to pricing of the loan from wholesale lenders that is highly, highly competitive. So as a consequence, the price I can deliver that loan to will ultimately allow me to pass on to those savings to the borrower, to where they're going to end up getting a better deal than if they went to a major bank. Or, as I often say, if they're kind of sort of sucked into the idea that you got to go to an internet lender to get the best deal, like Rocket Mortgage, very often that's just not the case. I can very often offer a better rate than some of those big internet-based lenders, despite the fact that they try to market themselves as the best price option for the borrower.
Well, that's really shedding some light in some corners that we as homeowners or buyers would have certainly thought the different. We would have thought that, hey, you guys as brokers must be more expensive, but you're saying they're not. Can you take some time and explain the various fees that home buyers may encounter when working with a loan broker like yourself, and what are the typical costs involved?
Right. And actually, one more other point about why a mortgage broker. In the past, one of the other big objections about a mortgage broker was that we didn't have control enough of the whole process. Yeah, we can take the loan application, we could package a file for the borrower so that we can then deliver it to a lender to be underwritten and funded. And so the old argument was a mortgage broker didn't control enough of that process. And so that's where things could get off the rails. Well, I would argue these days, most wholesale lenders, their platforms, that we call them, their systems that we brokers use to register a file with them and get it delivered through their system, are very efficient, very quick. And in most cases, we don't have the control problems that we used to have as a broker. So I just want to make that point. Now, in terms of fees, fees are something that I've always had a little bit of an issue to, because I think lenders in general, all four of the providers I described, including mortgage brokers, I think we get a little bit of a bad rap on fees and closing costs overall. One of the things I would want to point out to borrowers is understand that as a mortgage originator, from a regulatory perspective, we are required to disclose to you estimated cost for getting a mortgage, even though many, and I would argue most of the fees involved are not coming from us. They're coming from other parties. So the first thing I would want folks to realize that in terms of fees, you're going to have two sets of fees on a mortgage application. You're going to have what we call non-recurring closing costs. Now, these non-recurring closing costs are, I would describe as non-recurring, meaning they're only going to happen one time, third-party fee-based costs for services rendered. So what does that mean? Well, different parties involved in the process. The appraisal company, they're going to do an appraisal, have to be paid for it. The credit report company, there's going to be certain third parties where we have to get information on the borrower. Verification of employment. Many major employers use a third-party vendor to provide that verification, and that third-party vendor charges a fee, which, by the way, is not cheap. It can be $100, $150 just to get a piece of paper to verify the borrower's employment. There could be a fee to get a copy of the insurance policy for condo development. We have to go to what's called EOI Direct, a third-party vendor that'll provide that declaration page. And again, it's not expensive. It's not cheap. It's like another $150. We have to get a questionnaire completed on a condo. We have to go to the property management company and ask for that questionnaire to be filled out, and they can charge anywhere from $200 to $400. So all of these fees that I just mentioned really have nothing to do with the lender per se. They're third parties that the lender has to use to help provide that loan to the customer. And then the other part of the non-recurring closing costs are going to be the other third parties, the escrow company and the title company. So you got your escrow fee, your base escrow fee, your lender's title policy, endorsement fees, wire fee, all of these fees that are coming from the escrow and title company. So if you think about it, everything I just described, that's quite a few fees. They add up to a good amount of dollars. And actually, none of what I just described is coming from the lender, yet we are the messenger. When we start an application, we have to provide a detailed estimate of all the costs. Again, even though most of them are originating from someone other than us. So what do we charge, or what fees do come from the mortgage originator, whether it's a mortgage broker or a bank? Well, basically, it's going to be an origination fee, which historically was 1% of your loan amount. And we can go way back in history where that really came from. It goes all the way back to the days when FHA was created, because initially the idea was you get an FHA loan. This is back in the 1930s. And the lender originating the loan would get paid a 1% fee for arranging the loan. So even these days, that can happen occasionally, although most of the time when we arrange a loan, it's going to be at 0 points. But occasionally there could be an origination fee involved. So that's one lender fee. Then the other is, like all the lenders we deliver loans to, they're going to have a flat fee of some sort Some call it admin fee. Some call it underwriting fee. That's generally going to be about $1,000 plus or minus. And then the other item that could be charged by a lender or mortgage originator is other, what used to be called, and some people still do call junk fees. That can be like processing fee, document fee, underwriting fee, and all those combined could easily add up to another $1,000, $1,500, even $2,000. So the point of all that is that whole non-recurring closing cost basket, in general, if you're talking about let's say a $500,000 loan, that non-recurring closing cost basket might total, assuming it's a 0-point rate, so there's no origination fee, no points, you're going to be looking at about $5,000 plus or minus. But what's interesting about that is, of that $5,000, I'd say about 80% of that isn't coming from the originator. It's not coming from the broker. It's not coming from the lender. It's coming from escrow and title and the appraiser and the credit report fee and the VOE company, et cetera. But because we are the ones have to disclose it from a regulatory perspective, we are kind of put into the basket of we're the ones charging all those fees, when in fact, most of those we are not charging. And in the case of Mortgage Works specifically, from the day we incorporated in October of 1997, we're coming up on our 26-year anniversary, we have never charged fees. We only get reimbursed for credit report and appraisal when we pay for it up front when they're ordered. We may arrange a loan where there's an origination fee because maybe a borrower wants to go with a lower rate, essentially buy down the rate. That can trigger an origination fee. But we've never charged any other miscellaneous junk fees. We don't charge a document fee or a processing fee or underwriting fee. We just don't do that. We never have. So that's one of the things that distinguishes us from other mortgage brokers that we compete with, as well as banks. Because you know what? Even banks, retail banks, I've seen sometimes they can have quite a fee list broken down with these different labels. We're pretty good in that regard. We don't charge them, never have, never will.
Art, this really is amazing because, as you said, 80% of those fees that we see as you're disclosing it, absolutely, we think, well, geez, you're charging us all this. When we say you, we think you as a mortgage broker, and now that helps clear this up. Now, I want to point out today is a two-part story, because I want to start next week where we leave off here is, okay, so now we understand the fees. How do you get paid and how does that all work out? So I want to start next week with talk about the broker compensation models. But this is a great start in starting to help the buyers out there understand, hey, the four main providers of loans and what are their fees and what's associated in those fees, and then start talking about, well, are all brokers compensated? Are all lenders compensated exactly the same way? I can't wait to get into that. So thank you, Art.
Yeah, that'll be a good topic for next week. It's quite a good amount of material there, and I think I think everyone will be pretty interested in what I have to say about that, because it's not what you think. So
I think that's great. Well, I'm going to turn it back over to you because I know you have a couple more things you want to talk about, and
right.
We'll finish up today.
Okay, thanks, Jeff. Okay, now on to our next subject, everybody. I'm going to go ahead and go over our closing question from last week. On that one, if you recall, there it is on the screen. Jeff just pulled it up. May non-taxable income be grossed up for mortgage qualifying purposes? This is an interesting one, and I actually use this quite a bit in qualifying certain types of borrowers. The answer, of course, the short answer is yes. It is possible to gross up income for mortgage qualifying purposes. Well, how does that work? I've showed you both here, Fannie Mae as well as FHA VA. With Fannie Mae, if we determine when we have our initial consultation with the borrower that they have income that they're receiving that is not taxable, for purposes of calculating a debt ratio, we can gross it up by 25%. So, for example, if you're getting $1,000 a month in Social Security, we can gross it up by 25% and use $1,250. Doesn't sound like a lot, but it can make a difference in calculating an accurate debt ratio and help get a borrower within the range that they need to get that loan approved. What type of non-taxable income is most common? Well, there's a list there for you. Child support, Social Security benefits, workers' comp benefits, and certain types of public assistance. Now, FHA VA is a little bit different. They also allow grossing up non-taxable income, but not by as much. With FHA, VA, we can gross up by 15% in most cases. The types of income that we can gross up are similar to the Fannie Mae list above, but as well, the FHA guidelines specifically note railroad retirement benefits as well as military allowances. So this can come in pretty handy, particularly maybe for an older borrower who is on maybe some limited retirement type income that they're receiving. It's non-taxable. Being able to gross up that type of income can certainly make a difference in some cases in helping get a borrower qualified. So I thought this was a pretty good question to cover with everyone. So keep this in mind. It could be a big difference in terms of helping somebody qualify. And then for next week, our closing question is also a pretty interesting one. And here it is. And this is something that I end up also relying on every year for a couple of transactions. Can seasonal employment be used for qualifying income? Again, can seasonal employment be used for qualifying income? So if you're in a seasonal job, I'm having a hard time saying that. I'll have some good news for you about how we can use that to get you qualified to buy a house. So with that, we'll stay tuned next week where I'll have the answers and we'll be on the house. Back to you, Jeff.
Art, I love this. Every week we do something that just gets more and more in depth and understand the whole mortgage process better and how you, with as much expertise as you have and how many years. I mean, as an example, how many loans, if you just had to guess over your years in the business, that you've actually processed?
You know, that's a good question. Boy, I've never been one to track all that. I mean, of course, over the years you kind of keep track of your closings, but I've never maintained like a running tally since, January 6th of 1982, which is sort of my birth date in the mortgage industry. I've never kept a running tally, but it would be in the thousands. That's all I could say. So
I guess the reason I bring it up is, if I were going to go have, or someone was going to go have a knee replacement, would you want to have that knee replaced by somebody who's done 2 or 3 or done 2 or 3,000? I would probably go with the guy that has done 2 or 3,000, and I suspect it would be the same when you choose a mortgage broker. Choose Art Alvarez. You see his information on the screen here at Mortgage Works. Art Alvarez can be reached on his office phone at 760-883-5700, or of course, you always have the hotline. It is flashing now at 714-612-9035, and that is cell phone number. We determined last week that the only time he doesn't have it on, but he's now encased it in a waterproof case, is when he's swimming laps. That's why he's King Arthur, because he is absolutely staying in great shape for you to close your loans. And of course, you go to the website at mwloan.com where you saw the rate grid earlier. He keeps that up to date every day. And there's all kinds of calculators on that page. So it helps answer some of your questions there. And of course, you can always send Art an email. He loves communicating via email at art@mwloan.com. Art, before I let you go, any last thoughts about first of all, great information on this whole idea of, hey, who are the originators of loans out there? How does it work? And what are the fees associated with that? That's very enlightening, because about a year and a half ago, before we started our venture together, we had just refinanced our house, and I saw this big number. And yeah, I questioned my guy. I said, geez, how much of this are you making? This is crazy, because it was a fairly large loan. And he had to break it all down. I still was suspicious. Now I'm not. I have to go back and probably apologize for not being a kind gentleman. So thank you.
You were, as I said, Jeff, you were shooting the messenger.
I was. That's so. Yeah, I probably was. I certainly was questioning. I mean, and I guess as a home buyer and putting the loan together, it's okay to question those kind of things, isn't it?
Well, no, you should actually. I think that's an appropriate thing to do right from the get-go. And your originator is obligated, I think, to dive into that and give you a complete and clear explanation about all the fees and who's charging them and why. And so we always do that. And once you do, and I think most borrowers understand then.
Oh, we might have lost Art there for a second. As I said, we've been having a little bit of internet issues today, so we're going to wrap up. Make sure to reach out to Art if you have any questions, and he's always available. Remember, also, he has that new HELOC loan, and it's at 5-minute qualification. Get a hold of him if you're thinking about doing some remodeling on your home, or maybe you're going to put a solar on there, and you're thinking, hey, should I use my equity in my home to do that? Get a hold of Art at 714-612-9035 on his cell, or 760-883-5700 at the office. And with that, we'll see you guys next week on Mortgage Minute.